This is bad. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, despite the fact that the political elites from around the world continue to tell us that the labor market is strong and robust, we've seen shifts in consumer spending habits that indicate it's anything but. And this is the alarming truth that things have now changed based on some recent data we got today. As I'm about to show you, millions of workers from around the world are soon to hit the unemployment line. Now let's over to Bloomberg, where we picked today's story up with the headline is U.S. manufacturing activity contracts for a fifth straight month. And this is dangerous because it's not just the U.S. We're seeing further contractions in manufacturing sectors based on the survey data from manufacturers all over the world. And what this is telling us is the economy from the global perspective is entering a contraction, and where manufacturing goes, services follow. It's now a foregone conclusion. We're headed into a recession. And here we can see that U.S. manufacturing shrinks for a fifth straight month. Now, as we see the ISM data drop to 47.2, which was still better than last month at 46.8. Now, the key part here is that even though it is in contraction, it got marginally better. The issue is it's the fifth straight month. Things are getting worse, and that's not the evidence we needed to see a no landing, or even at better case here, a soft landing scenario. What it's telling us is the global economy, in particular the U.S. economy, which was supposed to be resilient, is now rolling over into a recession. The group's measure of production slid for a fifth month deeper into contraction territory to the lowest level since May of 2020. And keep in mind, that was just after the pandemic hit. The gauge of new orders, which showed bookings are shrinking, dropped to a 15-month low. And this is critical because if you work at any type of business that's in terms of manufacturing, new orders are your lifeblood. You need them. So when this gets smaller and smaller, as we see further contraction here, it puts pressure on the other side of the business, the backlogs. And when those are gone, well, you don't need as many employees. And that's the problem we're facing from manufacturers all over the world. Export orders also shrank at the fastest rate since the start of the year, despite the fact that we see a weaker dollar. Declining orders and persistent retreat in backlogs remain headwinds to production and illustrate a struggling manufacturing sector. While the ISM gauge of factory employment rose, it remained in contraction for the third straight month. So why we hear from the political elites that we saw perhaps a one-off non-farm payroll report, why we're at just about at the peak rate of unemployment, what we're seeing is it's going to get worse. And this is what Fed Chair Jerome Powell indicated at Jackson Hole, Wyoming, that he finally is waking up to the reality is that they didn't hit their targets, that we are indeed heading to recession, and he's worried about it. This is why he wanted a rate cut at the last meeting, and why we're likely now to get two cuts. That would be 50 basis points at the mid-September meeting coming up. When we talk about capacity utilization, it's very important to understand this has everything to do with inflation. When we look here at capacity utilization shown in blue, because we talk about decreases in production. Now, why does that happen? Because demand goes away. That's the issue here. And if you're a manufacturer and you're seeing a big decline in new orders, what is it telling you? It tells you your price is too high. So what happens, of course, that means you see prices come down. And it's exactly what you would expect. The consumer price index shown in red on a year-over-year rate of change. When you see a decline in capacity utilization, it means inflation is coming down. You see this throughout cycles going back to the 1960s. Each and every time. And so as everyone believed we are going to see a resurgence in inflation, the latest data on capacity utilization in terms of production output indicates inflation is coming down. That means panic mode for central bankers all over the world who are going to be eager to get some rate cuts in. But we talked about the effectiveness of rate cuts, and they're absolutely none. They're not going to make any changes. The problem is everyone believes they will. But the reality is, as we look to manufacturers around the world, and particularly here in the U.S., it means millions are about to hit the unemployment line, because when capacity goes down at a factory, you don't need as many workers. So the first move is you cut hours. The second move is if your order books don't increase, you start cutting heads. And sure enough, you can see the near mirror relationship between capacity utilization in blue and continued unemployment claims in red. And every anytime you see capacity utilization slow down, you see a sharp increase in continued claims, because what happens is workers get on the unemployment line, there are no opportunities elsewhere for them, and as they lose their spending power, as their income drops, well, that backfeeds into the economy, demand goes down, and further price decreases start to show up. But we can also see this in the new order book as we now look at manufacturers' new orders of durable goods. They're shown in red on a year-over-year rate of change against capacity utilization, and it makes perfect sense, because as new orders go down, well, that means, of course, demand at your factory is going down, and how much percentage of it is being utilized also goes down. We see that trend now, the current trend of new orders heading lower. We did get a one-off jump due to Boeing. Many believe this was a bottom and a turnaround. The reality is the ISM just flagged that this is not the bottom, which is why we saw a sell-off in equities and why we saw bond prices rally today, as the market is starting to figure out the Fed did not engineer the soft landing. They didn't engineer a no landing. They did what they do every time with 100% accuracy, is tighten financial conditions until we head into a recession. And elevated borrowing costs and uncertainty surrounding the November presidential election are prompting some companies to hold off capital expenditures and hiring. And I disagree with that completely. I do not believe it's election related, and believe it has everything to do with the consumer. They just don't have the money. And we talked about the savings rate last week and why this is so important. It's been drained down, and at some point consumers are going to need to save more. And why is that? Because there's not opportunity in the economy. There isn't enough wage growth. There's not enough hours. People are falling behind. And that's the real issue here, is consumers are seeing a shift in the economy and they're reacting with their spending. It really isn't a factor of the election. And still, the Federal Reserve policymakers are expected to be in lowering interest rates later this month, which should offer some relief. But the problem is, we know it offers absolutely no relief. Everyone's saying, gosh, if we could just get some rate cuts, it'll turn things around. The reality, in the past, we've seen rate cuts, and they do absolutely nothing to change the trajectory of the economy. As we look to, of course, consumer habits and to how it backfeeds into manufacturing, we just look at new orders, but again, it all comes back to retail sales. You see here in red, we're now looking at advanced retail sales. This is inflation adjusted, so it's real retail sales, shown in red on the year-over-year rate change, and you can see in decelerations in retail sales, well, that means, of course, retailers don't need as much inventory, wholesalers don't need as much inventory, so manufacturers don't need to produce as much inventory, and that means capacity utilization goes down. You see that happen here in the dot-com bubble. You see it going into the global financial crisis. You see it even around 2015, 2016. Just a mild slowdown in retail sales led to a huge drop in capacity utilization. We see that happening again going into the pandemic in the early stages. And look at now, we're sitting at this virtually zero band where we see inflation-adjusted retail sales can't even generate a plus on the column. That means, of course, consumers aren't buying enough and there isn't a demand. That means, of course, factories are going to see their production decrease. They're going to see their utilization decrease, and that is not what we're looking for. What it means is people are going to be hitting the unemployment line. The problem is, it's not just a U.S. issue. It's not just China. It's not just Germany. It's going to be every major industrialized nation. Because once you think back to the pandemic, we pumped up the global economy with massive amounts of stimulus and low interest rates, and everyone believed that suddenly we were in the new normal, that everyone believed that everyone was set back and they needed, of course, to unleash the animal spirits to go out and spend money. The reality is, without all that extra stimulus, you see the global economy come crashing down. That's exactly what happens when you overstimulate. You get a crash, and that's what's coming. Because we can now look to retailers' inventories shown in red. This on a year-over-year rate of change, and you can see here as it rises, you notice the zero band right across the horizon here. You see rising retailer inventories on a year-over-year rate of change. What happens when you don't get spending? Well, you see a decrease in capacity utilization as retailers just start ordering less. You see that happen here around 2004 to 2006 as we headed into the financial crisis. You see it led to slowdown around 2015. It was just a matter of too much inventory. Happened again in 2018 to 2019. And look, it's happening again now. You can very clearly see there just isn't consumer demand because wages are not keeping up with inflation. They're not getting enough hours, and sure enough, that means demand goes down. Even worse, as people get to the unemployment line, their incomes drop, you see a further decrease in demand. It starts to spiral right out of control. And one favorable development in the latest ISM data is that manufacturing customers are better managing their inventory levels. And this is a problem because the gauge of customer inventories has shown shrinking stockpiles every month since late last year. So what we're seeing here is customers of manufacturers are trying to weed down their inventory levels. The problem is they're not seeing enough new demand to go to manufacturers and put in big orders. This is why the order book is coming down. And this is a problem because this means manufacturers need to get their inventory in alignment before it gets out of control. This is the other problem we're seeing. Why aren't they laying off? Why haven't they been laying off? Because manufacturers are building inventory. Let's take a look here at the ISM data because look at this. We see for 5 months new orders in contraction, production in contraction for 3 months, employment in contraction for 3 months. It makes perfect sense. You don't have the order book, you don't need the workers. Inventory levels now stabilizing, but still too high. Customer inventory is going down because they want to get through that inventory. They want to weed it down because they know it's a pain point. But look at this, prices paid are going up. This is a dangerous problem here. People can't afford it. Manufacturers know it. And one way to get your costs down is to cut your employees. This is a dangerous game we're playing here. Look at this, backlogs of orders. 23 consecutive months they've been chewing through it. At some point, there's going to be nothing left here, and that's why you're going to see more and more people all around the world hit the unemployment line. Even new export orders, which many believe would rise on a weaker dollar. Didn't happen because we're headed into a global recession. Now let's turn to S&P Global where we get some further information here as production in their books fall for the first time in 7 months. But look at this, decline in demand. This is exactly the case we're making, leads to firms to scale back output. Renewed reduction in employment, that's key. Inflationary pressure strengthened. So we're looking at stagflation here, my friends. This is where you get rising unemployment and rising prices. Of course, we know how that plays out historically. Prices don't continue to rise. At some point, they roll over and head down as we come crashing into recession. This is exactly what happens. You see in the past, big increases in inflation. It inevitably leans right into a recession. We're on the exact path. It just took a lot longer than most people expected. The problem is they piled into U.S. equities on the hope the Fed got it right. They're starting to figure out they didn't. And despite a reduction in capacity, manufacturers were again able to work through outstanding business as new orders fell solidly. So what you're saying here is they had plenty of workers to handle the decrease in business. In fact, they had so many workers that backlogs of work were depleted for the 23rd month running, this matching the ISM, and at the fastest pace since April. So they're really getting quick through these backlogs. This is a problem because it's telling us they're running dry. They're almost gone. That's the danger part here. And on contrast to the picture for stocks and purchases, inventories of finished goods increased during August, the second month in a row in which this has been the case. Some response indicated they had made use of the spare capacity provided by a reduction in client demand to replenish stocks of finished products, while others noted unintended, here's a key word, unintended inventory accumulation. So they continued to build it in hopes people would come. They're buying into, if the Fed cuts, people will buy. Once we get past the election, people will buy. But what they don't realize is we're headed into a recession. So at some point, these manufacturers are going to see continued declines in new orders. They're going to have no backlogs and plenty of inventory. You figure out exactly what happens next, and it's called pink slips. And as was the case with production, manufacturers saw a renewed decline in employment midway through this third quarter. Staffing levels decreased for the first time in 2024 so far as we look to the end of the week for a blockbuster non-farm payroll report that I said is not going to happen. And what this reflects is falling new orders and lower output, exactly what you need to get rid of overstaffed companies. This is dangerous because, again, we've been told we need to see the economy rebound. We've been told the labor market is strong and robust, and we're about to find out it's anything but. But let's take a look at some of the details from the ISM report. Look at what these respondents are saying. A noticeable slowdown in business activity. Backlog has dropped at half as invoicing remains strong. but orders have slowed significantly. New order intake is sluggish at best. Interestingly, even though orders are down, inquiries are up. So people are checking in to see what the prices are, but not buying. And customers have indicated capital has been approved for equipment purchases, but they were directed to put projects on hold until the fourth quarter of 2024. Now, they note this indicates the uncertainty around the election. It doesn't indicate that at all. What it indicates is they're hoping that the economy turns around, because if it doesn't, those orders are not going to go through. You watch and see, because we are headed now squarely into recession. Our order levels are on a slow, steady decline. Business is cooling down. Everything is headed the wrong direction, which is why we see some validation in the energy markets here as Brent crude trembles below $75 a barrel, erasing all the 2024 gains. And you might remember not long ago, investors were mega bullish on energy. They thought that this is exactly what you want to see in the early stages of an economic boom. We warned you that wasn't the case. And sure enough, when we look at capacity utilization here against West Texas intermediate crude oil prices, what you see is a wonderful relationship that as demand goes down to factory level, well, energy prices follow. And so yet everyone remains bullish on rising energy prices because OPEC Plus is trying to constrain, of course, what's going on in the market to drive prices higher. What we're seeing is a setup for energy prices now to head even lower. This is going to be a boom for consumers who are looking for pennies right now, anything they can save expense-wise because they need the money, but it's not going to be enough to turn around the economy, because where this is going. I want to show you what's happening in Germany now, because it's a leading indication of what happens when demand comes crashing down. As VW waves the first ever Germany plant closure to cut costs, and remember, if you don't have demand and you have too much capacity, well, eventually you start to get rid of things that are expensive. This is factories. You start to trim your production facilities back to save money because inflation is running out of control here still, and yet demand is saying prices need to come down. VW waking up to the reality. Wait till this happens in America and we start seeing factory closures, because the potential measures also include trying to end the company's 3-decade-old pact with workers to keep jobs secure, the company said on Monday. And VW's main target is this underperforming namesake passenger car brand whose profit margins are getting squeezed amid sputtering transition to EVs. And here's a key part: consumer spending slowdown. So part of this has to do with the fact that China wanted to dump a bunch of cheap EVs into Germany. We know they wanted to do that, and it was going to destroy part of Germany's automobile business, and it's doing that. You can see these manufacturers like VW are hurting, and any shutdowns would mark the first closures in Germany during the company's 87-year history, if you can imagine that. But look at this. We talk about utilization, we talk about factory, we talk about production. Here's the data. Volkswagen last year made roughly 9 million vehicles. Compared with total capacity at 14 million. Makes perfect sense when you look at this from a business perspective. They don't need the factory running because it costs them money. They need to get their expenses down so they can be more competitive. Means more workers headed to the unemployment line. More demand is getting destroyed. Because the automotive industry is facing major challenges worldwide and is undergoing a profound transformation, to say the least, that requires companies to make strategic decisions. It's essential that companies and management act responsibly in close consultation with social partners, which is all a bunch of fancy words for send people to the unemployment line. So now you see why, based on the latest manufacturing data we got today out of the United States, that we are headed into a recession. This is mirroring exactly what we've seen months ahead in other parts of the world. And what it suggests is that millions of workers, not just Americans, from all over the world, are soon to hit the unemployment line. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.